Welcome everyone to our free webinar presentation this afternoon. Just some quick housekeeping issues before we get into the exciting meat and potatoes and give you some important insights into what this results season really means for your share portfolio. Firstly, please read the disclaimer section. Very importantly, I'm here to analyze what happened. I'm not giving you investment advice, so please speak to your financial advisor if you are a private investor and want to take some action. Secondly, the slides are available for you to download and keep below. Then please ask any questions as you have them. I'll pause regularly to answer as many as I can. If we can't deal with them all now, please keep an eye on the Zuan.com Retail Insights page, and I'll answer as many as I can in articles in the next few days. So just quickly to answer the one question of why should we all be listening to you? My name is Kirsty Lassinger, and I've had the incredible privilege and fun of working in investment markets since 1996. I've been a chartered financial analyst since 1999 and worked for a number of investment banks like JP Morgan and Investec. I've also worked for investment managers. This means I have seen a lot, from the bloodbath of financial results in 2001 to the consumer boom of the early 2000s, the global financial crisis, and now South Africa's very tough trading environment. I'm not going to claim I've seen it all, but it does mean that I have closely looked at these retailers for over 2 decades and have a lot of context to think about what stuff means. I was a top 5 retail analyst in the Financial Mail survey for many years and number 1 in 2010. And then my employer stopped participating in the survey, but I did still receive ratings from our institutional clients in their feedback. My colleagues used to call me the retail ninja because of the way I would take financial statements apart. I hope today that I can help you understand what is really going on here. So let's get straight into it, because this has been an amazing result season. Here is the roadmap for our presentation today, and it just shows you the 7 key things we're going to look at. So let's quickly move through some of the basic facts. This table shows you all the actual diluted HEPS and DPS numbers reported. You'll notice that only 2 of these retailers reported diluted HEPS growth. But I'll forgive all of you for thinking the actual earnings loss from a further 6.2 billion rand impairment of David Jones should maybe be mentioned here. Woolworths' result was also helped by a 53rd trading week, and without this fully diluted HEPS would have been down 2.1%. Cashbuild would also have reported an earnings decline of 6.2% if it hadn't been for its 53rd week. So no getting away from the fact that it's been just horrible, and it was the worst result season that we've seen since 2001. Let's now have a closer look at the food retailers. So how many of you knew that Massmart's South African food business grew faster in the 6 months to June than Shoprite's South African supermarkets, which were up 7.4% from January to June? If you look at just those 6 months, Woolworths was up 9%, so it continues to take market share. I think this means that we really have this idea of 2 markets becoming more entrenched. Upper-end consumers are still spending on at least small luxuries in the food space, and at the lower end, there seems to be evidence of downtrading. That's not just in terms of food, say from meat to chicken or fish, but in pack sizes and even leaving the formal sector to shop in less formal outlets that are closer to home. What's interesting is how little inflation there seems to be in the pipeline, even with the rand's recent depreciation. And then the more eagle-eyed among you would have noticed the very different performances by Shoprite's non-South African supermarket business and Massmart's food sales outside South Africa when measured in rands. Massmart was up 14.6%, while Shoprite's non-RSA supermarkets declined by minus 7.7%. These maps show the different stores by countries, and the key difference here is that Massmart has avoided opening in Angola and has relatively few stores in Nigeria and Mozambique. So Massmart has managed to have fewer stores in the countries that are really hurting right now, especially Angola, and then Nigeria and Zambia appear to be less important than they are in Shoprite's life. Then Massmart's secret weapon, if you like, is its over-indexing in Botswana. Now I'm mentioning this because Botswana's puller currency isn't actually a floating currency. It is really a basket of currencies that include the US dollar, the euro, Swiss franc, the rand, and the IMF special drawing rights. So when the rand depreciates against its trade-weighted basket, the puller will appreciate against it. If you would like me to write a more in-depth article about this and post it on the website, please tell me in the comments below, and then I can do that. Looking at the clothing retailers, both Truworths and Woolworths Fashion, Beauty and Home reported lackluster sales growth of under 2%, although Woolworths did have a better second half as it addressed some of its internal product issues. Inflation is still low, although out of the deflationary territory we saw last year. And yet both retailers have really managed their inventories well. Truworths maintained its gross margin, while Woolworths actually improved off last year's horrific base. Looking at the building materials retailers, despite the really tough sales backdrop, Massbuild's gross margin actually improved by 23 basis points, while Cashbuild softened slightly by just 10 basis points. Space growth has slowed across the board. Massmart's relatively high 3.3% growth includes one of the very large macro stores. It is guiding for this to slow to around 1.6% per annum compound through to December 2022. Woolworths Group number hides that this was driven entirely by the foods business. Fashion, Beauty and Home in South Africa and Country Road Group in Australia both contracted space, and CEO Ian Moore has promised that David Jones will do so as well from 2021. With the slowing space has also come some pushback at above inflation escalations from the landlords. Although this isn't new, the process of getting reduced escalations and even lower base rents or turnover-only related rents seems to be gaining some steam. So just to finish up the section with some observations, Massmart CEO Guy Hayward described the trading conditions as brutal, and I don't think there's a better word for it. This isn't new. Earnings have now been declining for at least 2 years in most cases of these 5 retailers. The problem is that it's hard to see conditions improving radically in the next 6 months at least. There are clear signs of downtrading in terms of product substitution and customers choosing to save transport costs by shopping with informal retailers closer to home. Also, the most telling thing about how tough the economy is that liquor is relatively robust. Shoprite's liquor sales were up 25.3% and Massmart's 13.6%. Inflation really remains subdued and well below the official CPI. This probably reflects the downtrading and that the retailers' product offers are much wider than the official CPI basket. Truworths is also showing a low acceptance rate of new credit customers, and from the tone of the commentary it feels like there is a bias to less rather than more new credit extension. And the group is trying to get to grips with the implications for the new amendment to the National Credit Act. Across the board, we think that management teams are controlling costs well, although some better than others. Most of the cost pressures have come in areas that are outside of management control, such as utilities, security, which is again a symptom of the tough environment, and the minimum wage changes that were implemented at the beginning of the year. And lastly, with the exception of Woolworths, there seem to be signs of further slowing since June, with the management teams mostly pretty downbeat in their outlook statements. Okay, so let's move on to the other 6 things that I think are really important out of the result season, and some of them are quite qualitative. We're going to start with a really important one, and this is what I've called Shoprite's hidden, in quote marks, currency costs. So just to recap, Shoprite posted a 19.6% fall in fully diluted HEPS for the year to June. I'm not going to go into a lot of the detail about the result now. I will tell you a bit later how you can get a free copy of our comprehensive report about its result. So stay with us if that interests you. So all divisions were down, but it was the African business that was in most pain. It posted a 265 million rand loss from last year's 650 million trading profit. Just to give you some context, this business made a 1.4 billion rand trading profit 2 years ago. The reasons were largely around the economic challenges a number of these countries face, especially commodity-dependent ones like Angola, Nigeria, Mozambique, and Zambia. Poor GDP growth means fewer customers could afford to shop in a supermarket, and remember that Shoprite is a premium brand outside of South Africa. There have been currency depreciations which were hard to pass through to customers, and so gross margins were squeezed, and then a lot of the costs are in US dollars, so you can see why the picture wasn't pretty with the currency depreciations. But in spite of all this, the income statement shows currency-related profits, and these are in 2 areas. The first is the hyperinflation adjustment in Angola of 920 million, and the second is the swing to 115 million exchange rate gain. Now this gain is on the mark-to-market of the balance sheets at the end of the reporting period. Does this make sense? Not really, and both of these are non-cash items, so they are reversed out of the cash flow statement. These are accounting profits and don't reflect what's really going on in the business. So let's unpack this in more detail. Now let's see what happened in the real business as a result of current foreign exchange depreciation. Intuitively, it doesn't make sense that currency weakness meant profits, does it? Remember, Shoprite owns many of its properties in these countries, and that these assets are funded by South African cash flow, South African finance, or international hard currency loans. The currency depreciation and related hyperinflation accounting should have reduced the carrying value of assets in Angola. Similarly, you would think that currency depreciation would also have hurt rand-denominated asset values in countries such as Nigeria, Zambia, and Mozambique. Well, it did. It's just not in the income statement. And the reason it's not is that there is a perfectly legal accounting get-out-of-jail-free card that says if you classify yourself as a long-term investor in a country, you can write currency losses on your asset values off against equity in the statement of financial position. The statement of changes in equity shows the net currency-related impact, including hyperinflation adjustments. It reveals that Shoprite effectively wrote 2.8 billion rand off its net asset value in 2019. This was well up on last year's 680 million. In fact, cumulatively, Shoprite has written a net 4.7 billion off its equity because of currency depreciation in its non-South African businesses since 2010. So the bottom line here is that yes, there is an amazing long-term opportunity in formalizing food retail across the African continent. But if you own Shoprite shares or are thinking of owning Shoprite shares, you need to think through the implications of long-term currency movements, because this is real money spent on real assets that haven't held their value. And the key question is whether these currencies are structurally challenged and will continue to depreciate against the rand over time. And while we're talking about Shoprite, let's move on to our next key takeaway from the results season. This was the scariest thing I've ever heard a CEO say in a result presentation. It was Shoprite CEO Peter Engelbrecht. I'm paraphrasing, but it was like this. We think there will be regulation of food prices in future because of scarcity, so we are diversifying our income streams. Why did I think this one sentence was so terrifying? 2 reasons. The first is trying to imagine such poor food production, presumably globally, that would result in price regulation. Shoprite pulled out of Zimbabwe because of the difficult trading environment that is characterized by price controls and scarcity. Or perhaps there's a view that food retailers would be an easy political target for regulation, given the levels of poverty in South Africa. And the second reason is what it means for competitive dynamics and profitability. Someone whom I regard very highly once commented that when he buys a 100 rand bag of groceries at the supermarket, the car guard in the car park earns more from that transaction than Pick n Pay or Shoprite or Spar. And as funny as that is, it's also true. This is an industry with extremely tight margins. As you can see from the chart, Shoprite effectively made 1 rand from every 100 rand excluding VAT spent in its stores. This is not an industry that can afford to have gross margins slashed by 50%. Not if we want it to keep working in the highly organized and efficient way it does. Right, we'll move on to the next thing. And now we're going to talk about debt. Some of you may have seen my article debunking the argument that Woolworths is drowning in its debt. If you haven't and you're interested, you can find it on the Retail Insights page at zoo1.com. But briefly, Woolworths looks okay, assuming the Australian operations don't deteriorate further. Interest cover is a healthy 4.5 times, and the net debt to EBITDA was 1.6 times. Typically anything below 2 times is regarded as good, and the banks will look for something to be below 3 times. However, we are concerned that Massmart's loss-making situation makes it vulnerable from a debt perspective. Its first half operating profit didn't cover its interest bill, even if you take out the notional interest charge due to the change to IFRS 16. But it is too soon to panic. Its full year guidance implies just about positive interest cover on the old accounting statements. EBITDA is typically stronger in the second half, and year-end debt is usually seasonally lower. And then don't forget that Walmart has lent to Massmart before, so we think it could be a banker of last resort. But nonetheless, it's clear that the group needs to fix its 2 problem children, mass discounters and mass cash. Which brings us to our next topic, is Game South Africa's first online retailer victim. In the US, Walmart's biggest and arguably most dangerous competitor is increasingly Amazon. In South Africa, Takealot has grown by leaps and bounds, although Naspers seems to be replicating Amazon's philosophy around market share and scale first and profit afterward. The charts show our estimate that Takealot's revenue is now over 6 billion rand, although growth has been helped by its acquisitions. We have split out the mass discounters food component to just show its general merchandise revenues, and these have dipped in the past 3 years. And while this is partly due to Takealot's relentless customer recruitment, I think it's also about Game's internal issues. Its stock management could have been better, although hopefully the change to SAP will change this. Customers can't buy stock if a store doesn't have it. Also, Game only opened its own online store towards the end of 2017, and it was only completely functional in 2018. So Game has given Takealot a substantial first mover advantage in online. And then as a personal observation, Massmart's online turnaround times seldom compete with Takealot's. But again, this can be fixed. I think it's too soon to write Game off as a victim of an online onslaught. While online competition is growing, I think Game's issues are primarily about systems underinvestment over a very long time. And this has now been changed, although the benefits are delayed. Right, let's move on to Woolworths. There is no way to sugarcoat that David Jones' performance has been just awful since Woolworths bought it in 2014. And the benefits of the changes Woolworths has made to this business are simply not evident so far. In some ways, you could think that Woolworths' poor execution has exacerbated the problem, and the CEO revolving door in David Jones can't have helped. This impairment, the second impairment, is one clear signal that the group has acknowledged it significantly overpaid. And I think the second reduction of the margin target guidance in 2 years is extremely worrying, especially as Woolworths has a poor track record of meeting its margin targets in its clothing businesses. There are three clear problems. Top line has not grown well enough, the Elizabeth Street revamp hasn't helped, and the group does need to do that. And the end to that is now in sight. So we will see what happens in the next 6 months. Gross margin has not been managed properly. The owned by gross margin has fallen from 45.1% in 2014 to 40.9%. And the lower margin concession business has actually grown to 34.1% of sales from 30.2% in 2014. So this mix has hurt too, and this was really not the plan. And then, of course, costs have increased relative to sales despite the significant changes made to the cost base by Woolworths through doing things like moving the head office to Melbourne and taking quite a lot of cost out of the business in the last year or so. But it's not all doom and gloom. There have been some benefits like the improved concession gross margin, which is probably due to expanding the CRG concessions in the business and weeding out some of those that were less successful for David Jones in driving footfall. And the improved trading density also shows that the group's strategy of reducing floor space where it can has paid off. Importantly, there is now a clear line of sight of space reductions to come from 2021. And the good news is that the current share price basically implies that David Jones is worthless. To answer the question of whether Woolworths is losing the battle, you need to take a view of whether the internal change initiatives can come through fast enough. The group is clearly getting its hand around its cost base. The trading space rationalization is in the post. It's just a matter of whether it can come through fast enough. Top line is important, but the gross margin is the key. The new system should help, and we have seen benefits in South Africa from the same change. And maybe most importantly, Ian knows that this is his legacy, and he has a good track record in turning Country Road around through implementing many of these same measures. All right, let's move on to some of the accounting standard changes. Massmart gave us our first glimpse of what IFRS 16, which is all about lease accounting, looks like. I was certainly surprised at how much the income statement was hurt, by 376.2 million, and of course the balance sheet looked very, very different. It sounds as though the timing differences will mean that the change to IFRS 16 will actually make the income statement better compared to IAS accounting from about 2021. Similarly, Shoprite has guided for an IFRS 16 earnings cut of between 530 million and 830 million, and again the positive swing should come through in 2 years' time. My tuppence worth for what this means for how we look at these businesses is that we will probably all need to move to looking at pre-tax margin rather than trading or operating margins. I think that may not actually be a bad thing, as it will give us a better picture of how well the management teams manage their businesses, including their decisions about financing. I know some of you are concerned about whether the banks are going to be more reluctant to lend to retailers given the extent of the change. We'll have to see, but I do know that the credit departments already were factoring in a lease capitalization exercise to understand the extent of the effect of off-balance sheet debt implied by a lease. I think the most intriguing part of the effect of the implementation of IFRS 16 is on Massmart's free cash flow generation. While it is true that the change in accounting standard doesn't affect the group's overall cash position, it does change free cash flow. And as the table shows, free cash flow is some 735.2 million rand better off under IFRS 16 than the previous IAS framework. This has, I think, some important implications for equity valuations, where investors use discounted free cash flow models to value companies. Perhaps we need to factor in the change liability as well. I'd really appreciate any thoughts any of you have on this. And before we conclude, I would just like to ask, who here is looking forward to their next client or trustee meeting? Are you looking forward to explaining why you didn't sell your Shoprite shares, or Massmart, or any of the others? Could you have made better investment decisions if you'd known at least some of what I've shared with you today? Would you like to attend more presentations like this? Well, you can. Our next presentation, called Has Shoprite Lost Its Mojo?, is on the 19th of September at 3 p.m. In it, we'll discuss whether Shoprite can grow further in South Africa and take more market share. Is Shoprite earning a real return on its investments, both inside and outside South Africa? And why is Shoprite's cash flow generation so poor compared to its earnings? Does it risk losing its focus with its new growth strategy? And what is the potential upsides and downsides? And maybe most importantly, can the group get back to a 5% plus trading margin? If you own Shoprite shares or you're thinking about going long or short, you need to understand all of this. But there is one catch. It's a closed webinar and only our Retail Insights subscribers can watch it live. But if you sign up for a 30-day free trial, you will be able to attend without paying a cent. So why would you want to become a member of the Retail Insights Club? Maybe most importantly, you'll better understand the retailer's financials, so you'll be able to make better investment decisions. You'll be able to impress your colleagues and clients with your deep understanding of the retailers. You will get all the benefits of my 20 plus years of experience analyzing retailer companies without having to spend the time yourself. You will get the analysis in bite-sized chunks so you can easily understand the most important issues when you need to. And you will get regular and exclusive webinar presentations just like this one, so you get all the information you need in just 1 hour instead of spending the time plowing through results and reports yourself. And you won't have all those awkward moments of explaining that you didn't know important information. So let's pull everything together. What you get for that 100 Rand membership a month is this: a monthly closed and exclusive webinar presentation, like this Has Shoprite Lost Its Mojo presentation. You'll also get the first invitation to our open webinars like this one. Every week in your inbox, you will receive at least one insight article and often more. You'll also have access to our full archive of articles, presentations, and reports. When we publish our research reports, you get 50% off discounts on the cover price. And of course, there is a 30-day free trial. Also, if you sign up for the Has Shoprite Lost Its Mojo webinar before 2 o'clock on the 19th of September, you will get a free copy of our in-depth analysis of Shoprite's result. And here the normal selling price is 250 Rand. So please visit the website for more. Just finishing up now, this has been a very tough result season for not just retailers, but the shareholders as well. The retailers have mostly, with the exception of Massmart, managed gross margin and controllable costs well. I think the most uncomfortable thing was finding that Shoprite's cumulative currency-related write-offs nearly doubled in this 1 year. And at Massmart, the pressure is now on for it to turn mass discounters and mass cash around to avoid a debt trap. At Woolworths, it's not only David Jones. The group needs to execute well, more consistently across all its clothing businesses. And then IFRS 16 looks as though it's going to hurt earnings more than we imagined, and the retailers are more exposed than other sectors. So keep your eyes open. I look forward to seeing you on the 19th of September. Thank you and goodbye.